Good morning, everybody. Myself, CS Vivek Banerjee. I will be taking today's lecture on security valuation, the first part, valuation of equity shares. But students, before that, uh, some assignment questions were left during my last lecture on technical analysis. Let us take it first. There were two questions, question number one, question number two, which were left. So, question number one was, what are support and resistance in technical analysis, and how does it influence investing decisions? Explain it with practical examples. So, as I have mentioned during my lectures also, support is a price from which the particular share price will not fall down. And resistance means it provides a resistance, means when the share price reaches that level, the chances are that it may not go up. It just work like this. So you can say this upper level, it is resistance. So some term resistance is given because it is a level from which the share prices are likely to fall. Likely to fall. If you see that it goes up, goes down, goes up, and then it doesn't breach this level. It doesn't breach this level. It doesn't breach this line. It again begins to fall down from this level. So at this level, you can say the technical analyst at this point will tend to sell at these points. They know that it is the maximum limit from which the share prices will not increase, and from that it will fall down from this level. And this provides the support. This is the support. So as the name suggests that it provides a support, means from which it will not fall down. Once it reaches this level, it again goes up. It reaches this level, again goes up. It doesn't breach this level, this low. So what will be the strategy of the technical analyst in such situation? In such situation, the strategy of the technical analyst will be to buy in such situation because they know from this level it will not come down. So this is the low. But it doesn't mean that you can say the market doesn't breach resistance and support level. It does breach the resistance and support level. But most of the time, but it takes a while to actually breach this level, the support level and resistance level. When it reaches the resistance level, it creates a new resistance. As soon as let us, for example, it breaches the support level, then this will create a new support. Okay. Good morning, everybody. Shruti, Viraj, Shailesh, Shankara. Good morning. Okay, head and shoulders. Now come to the second question. What is the difference between head and shoulders and inverted head and shoulders? Also discuss their significance. So I will go to the page to discuss it. Head and shoulders. So head and shoulders basically work like this. It is a neckline. This is one shoulder, the left hand side shoulder. This is another shoulder, that is the right hand side shoulder. This is the head. Okay. And this is also called the neckline. So as soon as it reaches this dotted line, at this dotted line, the technical analyst will like to sell. They will say that yes, this is the beginning of the bear phase. Let us sell at this point. There's a logic behind it, the psychology behind it, the behavior of the people behind it. Because if you see that here the bulls gave their maximum strength, it again falls down it bulls again charge their maximum strength, but it didn't reach this previous level, previous high. Then from here onwards, it fell down. And when it breaches this previous low, this is the previous low. When it breaches this previous low, one can say, the technical analyst can say that this point it is time to sell, because now the strength of the bull has faded, because they had put the maximum strength here. Here the strength will start to diminish. Once it falls down, the bull strength started to diminish because it didn't breaches this previous high. And then when it breaches this previous low, this is a confirmation on the part of the technical analyst that yes, it is now the beginning of the bear phase. It is the time to sell. Now come to inverted head and shoulders. This is the one shoulder. This is another shoulder. This is the head. And this is the neckline. So once it breaches this neckline, the decision of the technical analyst will be to buy. They said, yes, this is now the beginning of the bull phase. It is time to buy. Again, in this, the behavior and psychology of the people plays a very vital role. Here, if you see, the bear have extended their maximum phase, maximum strength here. They pull it down here. Again, bulls give their strength. Again, bear showcases their strength. It put the shares to fall down here. But if you see that at this level, it doesn't breach the previous low. It doesn't breach the previous low at there. And when the bulls try to this pull themselves up, it breaches the previous high. See, it breaches the previous high. So once it reaches the previous high, the technical analyst got a confirmation that now the strength of the bear has faded down and it is the start of the bull phase, and it is now the time to buy. So this is the significance of the head and shoulders and inverted head and shoulders. So any questions regarding this? Actually, once the share prices have, you can say, in point and figure chart, it has fallen down to rupees 23. So I will just try to go back to that. Just give me a second. Okay. Okay, I will try to this by way of a figure. By way of explaining the study material, I will take this question after the break. And in the meantime, if you see closely that in that point, what I remember that in point and figure chart, the share prices have been decreased till 23. So O will be placed till 23 also. But I will try to explain this with the help of the study material also. So after the break, I will explain this portion, point and figure chart. And yes, the order lot theory, no, it cannot be said to be similar to fundamental analysis. Okay. Now come to the question five. Question five of this in your assignment for technical analysis. And this question is part of the run test. So just follow this question, just observe this question, and then we will solve it. It is in front of you, question number five. I hope you have downloaded it. Even if you have not downloaded it, if you can take the screenshot of this, I will try to this shorten it. So can you take the screenshot? You can take the screenshot of this and you can solve it simultaneously with me. Or if you have the downloaded portion, well and good. If you have the printed portion, then that is fine. So shall I begin this, the last portion of this technical analysis assignment portion? Okay. So this is question number five. First of all, I will write down whatever is given into the in the question. It closing index value 110.07, 310, 07, 410, 07, 510, 07, 810, 07, 910, 07, 10, 10, 07, 10, 07. 241007. Next is 251007. Then 291007. 301007. Then 311007. Index value. Now write the index value 2800, 2780, 2795, 2830, 2760, 2790, 2880, 2960, 2990, 3200, 3300, 3450, 3,360, 3,290, 3,360, 3,340, 3,290, 3,140, 3,6. I think something is missed. Let me check. 2,800, 2,780, 2,795, 2,830, 2,760, 2,790, 2,880, 2,960, 2,960, 2,990, 3,200, 3,300, 3,450, 3,360, 3,290, 3,360, 3,340, 3,290, 3,240. Here it is 3,000, 3,240 it is. And 30th it is 3,140. And 31st it is 3,260. Fine. So what we got the date closing and the index value. It is 1 month figure on the month of October. Now let us see the question again. This is the question. This is the question. The closing value of a stock market index for the month of October 2007 is given below. Now, you are required to test the weak form of efficient market hypothesis by applying the run test at 5% and 10% level of significance. Following value have been used. Value of T at 5%, this is given. Value of T at 10% at 18 degrees of freedom is given. Now, you will be able to, right now by going through this question, you are not able to understand that what is it is about and what the question is trying to ask. But as soon as we proceed through this by solving this question, you will be able to understand that what this question is actually all about. Let us begin this question by beginning by solving this question. Okay, now see, first of all, we will see that whether the index value is decreasing or increasing. So any decrease will shown by a plus sign, any decrease will shown by a plus sign, and any increase will shown by a plus sign, and any decrease will be shown by a minus sign. So from here, you can say that it is deducted from 2,800. On 1st October it was 2,800, and on 3rd of October it decreases. It come down from 2,800 to 2,780, so it decreases. Again an increase from 2,780 to 2,795, plus sign. Again an increase, decrease, again an increase, again an increase, 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 increase. So from here, increase, 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 increase. From then it is decrease. Again a decrease, again increase. From 3,360 to 3,340, again a decrease, further decrease, then further decrease, and lastly increase. So what we did, we places plus sign in front of those figures which have shown a positive sign, which have increased, in which the index value increased. So we put the plus sign, and wherever the index value has been declined, we put the minus sign. So let us see how many there are plus signs and how many are there minus signs. So 1, 2, 3, 4, 5, 6, 7. 4, 5, 6, 7, 8, 9, 10, 11. So there are 11 plus signs. If you see that there are 11 plus signs. So we denote the plus signs by N1. So N1 is equal to 11. Means 11 times the index value have increased. Now we calculate the minus signs. 1, 2, 3, 4, 5, 6, 7, 8. There are 8 minus signs. So minus signs we will denote it by N2. N2 is equal to 8. So number of times the index value of decrease have been denoted by N2 minus sign, which is 8. Now, what is the run? We will denote run by R. What is the run? And what do you mean by run actually? Run means at which circumstances the index value, the index, that is whether it is the Sensex or whether it is the Nifty, have changed course. कौन सी ऐसी सिचुएशन है जिसमें इंडेक्स, दैट इज जो सेंसेक्स है, निफ्टी है, उसने अपना कोर्स चेंज किया, मींस वो बढ़ रहा है, इंक्रीज हो रहा है, एंड देन इट डिक्रीजेस फ्रॉम देयर. सो वी विल पुट रन एज दो सिचुएशन इन विच द इंडेक्स हैज चेंज्ड कोर्स. Means it is increasing for some time and then decreases, or it decreases for some time and then suddenly it increases. So number of runs, let us calculate the number of runs. First, we begin here. From 1st October to 3rd of October, it decreases. So this is one run. It changes course. Then again, it is a plus sign. So it again changed direction. This is the second run. It increases from 2 days, from 4th of October and 5th of October, 2 days increase. Again on 8th of October, it decreases. So it is the third run. Third time, the Sensex, the index actually changed its direction. Just give me a second. And again on 9th of October, it increases. So it will be fourth run. Again, the share index actually changes direction by going up. And then it is the upward sign for some days. From 9th of October, if you see from 9th of October here to up to 17th of October, there is an increase. Then on 19th of October, it shows a decrease. So it is the fifth run. On 19th of October, again, the index changed course. It shows increasing sign and then again it decreases. It decreases for 2 days, 19th of October and 22nd of October. Again on 23rd of October, it increases. So it's changed direction on 23rd of October. So on 23rd of October, it will be sixth run. Again on 24th, it decreases. So it will be seventh run. And this decrease continues for 4 days, from 24th, 25th, 29th and 30th. Again on 31st of October, it increases. So it will be the eighth run. Okay, now we're able to understand that we have calculated the run. First of all, we calculated how many times the Sensex have increased its value. Increases, a number of times increase during the month of October is 11. And number of times it decreases is 8. And what is the run? Means number of times the Sensex has changed its direction from either increase to decrease or decrease to increase. It is the 8. Now, whether this run of 8 means the number of times when the index has changed its direction satisfies the weak form of efficient market hypothesis. What is the weak form of efficient market hypothesis? The weak form of efficient market hypothesis tells us that the market price reflect the past prices. The current market price absorbs all the information in the past. It is a weak form of efficiency. So whether we can say that during 1 month, during the course of October for 31 days, when out of 31 days, the Sensex has changed direction only up to 8 times. So this 8 times or the number of run shows weak form of efficiency. We cannot tell with certainty. So for this purpose, first of all, we will calculate the average. This average is generally denoted by mu. So it is calculated as follows: 2 n1 n2 upon n1 plus n2 plus 1. So this is the formula of the average. Let us calculate it. 2 into n1 we know 11, n2 8, divided by n1 11 plus 8 plus 1. So let us calculate it. 11 into 2, 22 into 8, 176. So 176 divided by 11 plus 8, 19 plus 1. Is 10.26. The average is coming to 10.26. I hope you all getting the same answer. Now this average of 10.26 signifies the weak form of efficiency. We still cannot tell with certainty. So what will be the next course of action? The next course of action will be to calculate the standard deviation. What is standard deviation shows? Standard deviation will show the deviation from this current average. Means how much deviation is permitted from this 10.26, that is on the higher side or on the lower side. So first of all, let us calculate the standard deviation. Standard deviation. The formula of standard deviation is under root 2 n1 n2 multiplied by 2 n1 n2 minus n1 minus n2 divided by n1 plus n2 square multiplied by n1 plus n2 minus 1. So this is the formula of the standard deviation. So let us put the figures into the formula. So it will be 2 into n1 11 into n2 8 multiplied by 2 into 11 into 8 minus 11 minus 8 divided by n1 plus n2 11 plus 8 square 11 n1 plus n2 minus 1 11 plus 8 minus 1. Again solve this. 2 into 11 into 8 176. 2 into 11 into 8 176 minus 176 minus 11, it is 165. 165 minus 8 157. 11 plus 8 19. 19 square 361. 361. 11 plus 8 19 minus 1 is 18. Again solve this. Here solve this. 176 multiplied by 157, it is coming to 27,632. 27,632 divided by 361 multiplied by 18. 61 multiplied by 18 is coming to 6498. 6498. 98. So how much it is? 27,632 divided by 6498 is 4.25 under root 4.25. So under root 4.25 is coming to 2.06. Coming to 2.06. Yes, Uday. You can say N1 and either of it can be taken. It is not that, but it will be more logical that if the index value is increasing, then N1 will be taken. If the index value is decreasing, then N2 is taken. But it is not a hard and fast rule. Okay, so it is coming to 2.06 standard deviation. So please check if it is the answer is coming to 2.06 in your case also. So this is the formula. We have calculated this. Now, the standard deviation 2.06. How much standard deviation is permitted? 2.06 means from 10.26, this average 10.26. 2.06 deviation is allowed. Means 2.26 from 10.26 on the upper side, or 2.06 from the lower side is allowed. Such means that much deviation is allowed from the average. Okay, fine. So this provides you can some amount of evidence that yes, if that such amount of deviation is permitted, and it may show the weak form of efficient market hypothesis. But still, we are not 100% sure. We cannot tell with certainty that this average of 10.26 and this deviation, standard deviation we have calculated, shows that the number of runs, that is 8, we here calculated, shows the weak form of efficiency. So now what will be the next course of action? The next course of action will be to do a run test in order to be, you can say with certainty that yes, the number of runs, that is 8, is signifies the weak form of efficiency. Now, just go back to the question again. Here it is given that value of t at 5% degree of freedom is given and value of t at 10% degree of freedom is given. So we will calculate at both this 5%. Just give me a second. We will calculate at both this 5% and this 10%. Okay. Now, run test at 5% level of significance. 5% level of significance. Here, we will calculate both the lower level as well as upper level. Lower level, we can denote it by L1, and upper level, or you can say upper limit, and be more precise, we can give it as lower limit. Lower limit, and this is upper limit, L2. Okay. So this L1 is equal to mu minus t into standard deviation. And upper limit, it will be mu minus, it will plus t multiplied by standard deviation. Now mu, what we have calculated? The average we have calculated 10.26 here. 10.26. This is the mu or the average. And 2.06 here. It is the standard deviation. And the value of t is given in the question itself at 5% level of significance. See, the value of t here it is given. It is 2.101. 2.101 at this is 2.101 at 5% level of significance. Now calculate this. Put the figures into this value. Mu 10.26 already calculated. T it is given 2.101. 2.101 multiplied by standard deviation 2.06 we have just calculated. Let us calculate the lower limit. First we multiply 2.101 into 2.06. Then we deduct 10.26. It is coming to 5.93. It is coming to 5.93, the lower limit. Now we calculate the upper limit. Upper limit mu 10.26 plus t, the value of t is given 2.101 multiplied by standard deviation 2.06. So let us calculate this. Once the N1 we have taken that the number of times the index value have increased, and N2 we have taken the number of times the index value have decreased. So this N1 here it is given. N1 is the plus signs, means the number of times the index value has increased, that is 11. Means during the month of October, the index value has increased 11 times. And N2, the number of times the index value have decreased during the month of October. N2, it is denoted by the minus signs. Okay. Fine. Now, let us calculate the lower limit. It is coming to 14.59. It's coming to 14.59. Yes, Shankar, correct. Answer is correct. So lower limit is 5.93 and the upper limit is 14.59. Now let us analyze. 10.56, this is the average we have calculated. This is the lower limit, 5.93, and this is the upper limit, which is coming to 14.59. Okay. And this, the number of runs, what we have calculated is 8. So this 8, that is the number of runs, should be between this lower limit and the upper limit. So whether this number of runs, that is 8, is between the lower limit and the upper limit, the answer is yes. It is between 5.93 lower limit and 14.59, that is the upper limit. So we can say that it satisfies the weak form of efficiency. It satisfies the weak form of efficiency at 5% level of significance. So this is run test at 5% level of significance. So any question till that, I will do the 10% also level of significance in this. It will be more clear to you. Any question you can ask. Okay. Now do the run test at 10% level of significance. Again, we will calculate the lower limit and the upper limit. Lower limit signifies by L1. The formula you know, mu minus T into standard deviation, and the upper limit signifies by L2 is equal to mu plus T into standard deviation. So lower limit mu, we have calculated 10.26. Let us see the value of T. It is given in the question itself. The value of T here 1.734. 734 at 10% level of significance. 1.734. So T is 1.734 multiplied by standard deviation. We have calculated 2.06. Let us calculate it. It is coming to is coming to 6.69, the lower limit. Let us calculate the upper limit. Put the figures into the formula. Mu 10.26 plus T 1.734 given in the question. Standard deviation 2.06. Is coming to 13.83. Coming to 13.83. Okay. Now we will do the analysis. Now we will do the analysis. So this is the average. We have calculated 10.26. Mu we have calculated. Lower limit 6.69. Upper limit 13.83. And number of runs was 8. So in order to be satisfy the weak form of efficiency, the 8, the number of runs, should be between the lower limit and the upper limit. That is, this 8 should be between 6.69, the lower limit, and 13.83, the upper limit. Does it satisfy this condition? The answer is yes. The 8 is between this lower limit and the upper limit. So this also satisfies the weak form of efficiency. Weak form of efficient market hypothesis or weak form of efficiency. Okay. Yes, it is 10 point. Okay, fine. Yes, here it will be 10.26. It will be 10.26 here. Thank you for pointing it out. It will be 10.26 here. Okay, any questions regarding this run test? Okay, the most of the answers are right. You have also attempted it correctly. Now, just revise it how we have proceeded. Here, this was the question. So, what was the question? Question is day closing date and index value was given. You have to test that whether it satisfies the weak form of efficiency or not. For this purpose, you are required to do a run test at 5% and 10% level of significance. So how we have proceeded with the question? First of all, we have written that closing date and the index value, and any increase in the index value are shown by plus signs and any decrease are shown by the minus signs. So number of times we have seen the index value has increased is 11. So we denoted 11 by N1. And number of times the index value have decreases is 8 and it is denoted by N2. So N1 we have number of times it is increased 11, N2 number of times it decreases is 8. And number of runs we have also calculated, which is 8. How it is calculated? The number of runs means the number of times this index value has changed its course or changed its direction. It is 8 times it did that. We have also calculated it 8 times. It changed its course. Means it is increasing for some time, then it decreases. And sometimes when it increases, decreases for some time, it increases. And when it increases for some time, it decreases. Then we cannot say that the number of runs 8 actually, you can say, signifies efficient form of efficiency, weak form of efficiency. So we calculated the average, which is denoted by mu. So average is coming to 10.26. But this by getting this average of 10.26 also, we cannot tell with certainty that this figure of 10.26, this figure of 10.26 satisfies the efficient weak form of efficient market hypothesis. So we then calculated the standard deviation. So standard deviation is calculated by this formula. So we arrived the standard deviation at 2.06. So 2.06 means such amount of 2.06 deviation is allowed from the average of 10.26, either on the upper side or on the lower side. Good enough, but it is not certain enough to conclude that the number of runs, that is 8, signifies the weak form of efficiency. So what will we do? We will do the run test at both 5% level of significance and the 10% level of significance. So we did the run test at 5% level of significance first. We calculated the lower limit and the upper limit. Lower limit is calculated by this formula, mu minus t into standard deviation. The value of t is given in your question also in 5% level of significance, which is 2.101. So lower limit comes to 5.93 and the upper limit comes to 14.59. Then we did the analysis, that is this number of runs, that is 8, whether it is between the lower limit and upper limit. If it is between the lower limit and upper limit, then it satisfies the weak form of efficiency. So we can see from this solution that this number of runs 8 is between the lower limit of 5.93 and the upper limit of 14.59. So it satisfies the weak form of efficiency. Then we again did the run test at 10% level of significance. The lower limit we arrived at is 6.69, this 6.69, and the upper limit we arrived at 13.83. Again, we did the analysis and see that the number of runs 8 is between this lower limit of 6.69 and this upper limit of 13.83. So it also satisfies the weak form of efficiency. So the run test at both 5% level of significance and 10% of level of significance shows the weak form of, shows that the number of runs 8 satisfies the weak form of efficient market hypothesis. So I hope it is clear to you, the solution. Any question you can ask. Okay. So shall I proceed further? Now we come to the PPT. Valuation of equity share. Let us come to valuation of equity shares. I will begin. So, valuation comes after this fundamental analysis and technical analysis. So, what we studied in fundamental analysis, we studied in fundamental analysis that the fundamental analysis basically start with the economy, and then it comes to industry, and then to the company. Say, for example, it comes to a conclusion that yes, the from various reading various newspapers that the GDP growth rate is likely to increase. So if the GDP growth rate is likely to increase, it will give a boost to most of the industries. Then the fundamental analysis comes to the industry analysis, that which industries will get a boost up. It shows that yes, some of the industries which got which are under the production linked incentive schemes from the government, which are getting incentives from the government under the PLI scheme, or which the sectors which are giving a receiving because of huge infrastructure boost by the government are likely to do well, such as the cement sector, iron ore sector, that is the glass, the plastic, the automobiles, because of electric vehicle push. So all these industries are likely to do well. Then it comes to the company analysis that yes, from this steel sector, such of such companies are good because their management is good and because their financials are also showing a good position for the last 5 to 10 years. So this is the job of the fundamental analyst. Then technical analyst is altogether, the approach is altogether different from the fundamental analyst. It basically depends heavily on the behavior and the psychology of the people. So, in the technical analysis, we have studied the various, you can say, charting techniques, the various indicators, and we also did the efficient market hypothesis, and we did some practical questions and moving averages. Also, we did practical questions on simple moving average and exponential moving average. We see that simple moving average shows is helpful to the long-term investor, and exponential moving average is helpful to the short-term investor, because in exponential moving average, the average is more closer to the closing price. So it is more helpful to the short-term investors. Then we did some practical questions on efficient market hypothesis also. We did a run test just now. So this is what technical analysis is. So after the fundamental analysis and technical analysis, the you can say the investor comes down to valuation. So on the basis of the valuation, he can you can say make an make a judgment that in which company he should invest and which company share he should put his money. Now there are various concepts of return, required rate of return, the required rate of return, the discount rate, and the internal rate of return. We did all this during our, you can say, uh, during our intermediate course also. You knew what is required rate of return, what is discount rate, and what is internal rate of return. I will not delve, you can say, very deep into it. So just give a brief of what this concept means. Uh, yes, so there, this is a new chapter, valuation of security valuation. This is the fifth chapter, security valuation. So I will be taking the valuation of equity share part. Okay. Now come to these various concepts. Required rate of return. See the slide. Required rate of return is the minimum rate of return that the investor is expected to receive while making an investment in an asset. And you know, this is also called the opportunity cost, because it is the highest level of expected return foregone, which is available elsewhere for investment of similar risk. So you can say required rate of return is the minimum rate of return that an investor is expected to receive. Sometimes this required rate of return is therefore used as a discount rate also to actually discount the future cash flows. Now come to the discount rate. Discount rate is the rate used to calculate present value of future cash flows. And discount rate depends on the risk-free rate as well as the risk premium of an investment. So risk-free rate, basically, you can say the rate of the government bonds because government bonds are risk free, or the treasury bills, the interest rate on treasury bills can be taken as the risk free rate. And what is risk premium? We have seen risk premium during our this technical analysis. What is this risk premium? Risk premium is whatever equity shares are likely to get by investing in risky equity shares, because equity shares are riskier. Equity share riskier in comparison to treasury bills. So, if a particular person is investing in the equity shares of a company, he will be expecting some incentive. So that incentive is basically risk premium. It means he is receiving a premium on the risk he is taken. So actually discount rate depends upon these two factors, risk-free rate and risk premium. This will be more clear to you, this concept, risk-free rate and risk premium, by going through this further slides. When you go through the discussion in this chapter, this concept will be more clearer to you. Actually, each cash flow, now come to the this last sentence of this slide. Each cash flow stream coming from different assets can be discounted at a different discount rate. It is not that the same discount rate can be applied. A different discount rate can be applied in case of different situations. Now come to the internal rate of return. Okay, one query is there. Is this chapter same as cost of capital of financial management in intermediate levels? No, actually, this is not same. Cost of capital is one such part. It is actually extension of that, which is the valuation. So it is more or less similar, but it is more extension to this cost of capital. Okay, but the relevance of cost of capital is there. If a concept of cost of capital is clear, then it will be able to understand this chapter, I think, more. Now, what is internal rate of return? Internal rate of return is that discount rate which equates the present value of cash flow to its market price. You know the internal rate of return. The present value of cash flows is equal to internal rate of return is the rate at which the present value of cash flows is equal to the present value of cash inflows. Present value of cash inflows is equal to present value of cash outflows. Or in valuation of equity share, it will be said that it equates the present value of future cash flows to its market price. So this is the internal rate of return. And now come to the second sentence, that the internal rate of return is the average annual rate of return that investors earn over the investment time period, assuming that the cash flows are reinvested at the IRR. So I have not dealt with detail because these concepts are already you have learned during your intermediate course. So I am proceeding further. Equity risk premium. I think I will dealt with this concept in more detail. Equity risk premium, because this is new to most of the students. Equity risk premium. What is this? Equity risk premium is the excess return that investment in equity shares provide over a risk-free rate, such as return from tax-free bonds. So we can see that in case of tax-free bonds, say the rate of interest is 6%. Why is the rate of interest is low? Rate of interest is low because it is more secure. The investor is satisfied with lower rate of interest. Yes, ठीक है 6% मिल रहा है बहुत है. Actually safe तो है कि पैसा तो वापस मिलेगा. So that is why it is risk free. This tax free government bonds. And what about equity shares? Let us say the Nifty is giving a return of 10% on an average. Let us say for an example. And so it is a higher return. But why this is given a higher return? Because by investing in the equity share, the risk is more. So investor wants more return for the risk they are taking. That is what risk premium is. So this excess return, that is this 10% minus this 6%, actually compensates the investor taking on the relatively higher risk of investing in equity shares of a company. In this equity risk premium, I will take a practical example also so that it can be more clear to you. Okay. So let us take an example. Let us say risk-free rate, risk-free rate is equal to 6%. This risk-free rate is also denoted by RF. And market rate, or you can say Nifty, is giving a return of 10%. Okay. Beta, beta is equal to 1.2. What is beta? Beta means beta actually shows volatility. Beta actually shows volatility. It means how volatile the shares of a company in comparison to index, in comparison to Nifty or Sensex. In this case, the beta is 1.2. What it signifies? It shows that if Nifty say increases by 10%, then the share price will increase by 12%. Simultaneously, if the Nifty decreases by 8%, decreases by, for example, 10%, you take 10% itself, decreases by 10%, then the share price will decrease by 12%. So what it shows, this share price of a company, it shows that the volatility is more volatile. इस निफ्टी अगर 10% बढ़ रहा है तो शेयर प्राइसेस 12% बढ़ रही है और ज्यादा बढ़ रही है. अगर निफ्टी अगर 10% कम हो रहा है तो कंपनी के शेयर प्राइसेस 12% कम हो रहे हैं, तो इज मोर वॉलेटाइल. तो एक्चुअली बीटा शोज वॉलेटिलिटी, कितनी वॉलेटाइल है. इसका मतलब बीटा 1.2 सिग्निफाइज दैट द कंपनी शेयर्स आर मोर वॉलेटाइल देन निफ्टी. ओके. नाउ let us calculate the return, expected return. This is expected return is also signifies as cost of equity also. Because what is cost to the company is actually return to the shareholder. So in cost of equity, we are the emphasis is on the company. We are looking from the company's point of view. But in valuation equity shares, we are looking from the investor's point of view. And this is expected return is calculated according to the CAPM model, capital asset pricing model, which we will be studying in a later chapter. But for your own clarity, there's a simple formula. There's nothing very difficult about it. A simple formula of the CAPM model, which is RF plus beta multiplied by RM minus RF. So this, what is RF? RF we have taken as risk-free rate. This. And what is RM? RM is market rate. Is 10%. Beta, which is already given in the question, 1.2. So we put the figures into the formula. RF is 6%. Beta is 1.2. RM, that is market rate, that is Nifty in this example, is 10%. And risk-free rate is 6%. This is also called the CAPM model. CAPM model or the capital assets pricing model. Capital assets pricing model. Let us calculate this. So it is basically 6% plus this portion is coming to 4.8 is equal to 10.8%. So this expected return is 10.8%. My purpose is to clarify the concept of the equity risk premium. So what is this equity risk premium? The equity risk premium is this 4.8. This 4.8 is equity risk premium. So if you observe this example carefully, the investors actually require a premium or extra incentive of 4.8% beyond the risk-free rate, which is actually 6% in this example. 6% is the risk-free rate. But the investor want more because they are investing in a risky asset, which is equity shares. So this 4.8% is a equity risk premium, means the equity risk shareholders are putting in whatever risk they are putting, they want extra incentive or a premium of 4.8%. So this 4.8% is the equity risk premium. There is another concept as market risk premium also. So this market risk premium is actually 4%. That is this 10 minus 6%. So market risk premium is equal to 10% minus 6% is equal to 4%. So this 4% is market risk premium. Means how much market is providing in excess of the risk-free rate? It is 4%. Okay. So this is basically the concept of equity risk premium. Any question? Yes, Manisha, correct. That's equity risk premium beta into RM minus RF. So this portion is actually the equity risk premium, or you can equity risk premium, or you can also say that that's this portion beta RM minus RF is the equity risk premium. Good. Required rate of return, hurdle rate, equity at a minimum rate. Yes, they are used alternatively. They are used alternatively. What is discount rate? It is, if no, what is the difference? Discount rate, as I have said, that discount rate means the rate at which the future cash flows are discounted to arrive at the present value. So this required rate is basically the minimum required rate of return is basically taken as the discount rate. This minimum required rate of return is basically because that much required rate of return is taken as the discount rate, as you know. And internal rate is the rate of return at which the present value of future cash flows are equal to present value of future present value of future cash inflows, present value of cash flows and present value of outflows, or in this case valuation of equity shares, it is the present value of future cash inflows with the current market price, and it is the rate at which the it is reinvested. The actually cash flows are reinvested. So that is the difference between this IRR and the discount rate. Okay. Shall we proceed further? Fine. Now, required return on equity and required rate of return can be easily calculated with the help of the capital asset pricing model, as we have just did. That is RF plus RM. This is the formula which we have used. That RF plus beta into RM minus RF. This is basically the formula which is used in the capital asset pricing model to calculate the required rate of return on equity, or the expected return, or you can say the cost of equity also. The cost of equity are also calculated by this method also. So you also know that you have what you are studied in the intermediate, that cost of equity can be calculated with the help of the Gordon's model also, or it can be calculated with the help of the CAPM model also. Because if the assets are risky, then generally the CAPM model is applied. Now the main insight, now come to the second bullet point. The main insight of the CAPM model is that the investors evaluate the risk of an asset in terms of the asset's contribution to the systematic risk, which cannot be reduced by portfolio diversification of their total portfolio. Just see this second point, student. What is the main purpose of the CAPM model? The main purpose of the CAPM model is to let the investor evaluate the risk of an asset. Because I have just said that in case of risky assets, the CAPM model is used in terms of to the systematic risk of the portfolio. So basically, the emphasis of the CAPM model is related to systematic risk. What are systematic risk? Systematic risk are those risks as given in the bracket which cannot be reduced by portfolio diversification. मीन्स अगर किसी भी कंपनी आपके पास फॉर एग्जांपल आपने चार पांच कंपनियों के शेयर होल्ड करके रखे हैं, आपने उसको बढ़ा दिया 6, 7, 8, 9, 10, you increases up to 10, but still by this portfolio diversification means by increasing your portfolio, diversifying your portfolio by investing in the company, different shares of different companies. This systematic risk cannot be reduced, cannot be curtailed. Why? Because these risks are beyond the control of the company, beyond the control of the investors. So what are such risks which are uncontrollable? These risks are, for example, market risk, interest rate. If the interest rate is increased from say 7% to 8%, what will be its effects? It will increase the cost of capital of the company. Why? Because earlier the company was paying 7%. See, earlier the company was paying 7% on its interest. Right now, the cost of interest rate is increasing. So now it is paying 8%. सो कॉस्ट बर्डन बढ़ गया ना, 7% पहले इंटरेस्ट पे पे करती थी, अभी वो 8% पे कर रही है, तो कॉस्ट बर्डन इज इंक्रीज्ड. सो व्हेन कॉस्ट बर्डन इज इंक्रीज देन इंटरेस्ट एक्सपेंसेस ऑफ द कंपनी विल आल्सो बी इंक्रीज्ड. So in this way, it will put a burden on the company. So if the interest expenses are increased, the company's total expenditure will also increase and will put the pressure on profitability. So profitability will also come down. So it will put on the pressure on the company. So this systematic risk the company has to be prepared. And what is the amount of systematic risk? This actually can say denoted by this CAPM model. So systematic risks are those risks which cannot be diversified, which cannot be reduced by diversification. Third point is CAPM model provides a relatively objective procedure for required return estimation. It has been widely used in valuation. Yes, it is widely used in valuation, and it is used in the calculation of the required rate of return on equity when the particular, you can say the shares of a particular the shares of a company, assets of a company, you can say when the investment is riskier, when the investment is risky, asset class is risky, the risk is more than the CAPM model is used. Otherwise, the Gordon's model is used while calculating cost of equity. Yes, alternatively, the required rate of return is the discount rate is taken as the minimum required rate of return, or minimum required rate of return is taken as the discount rate in most of the cases. Systematic risk, undiversifiable risk. Yes, correct. Systematic risk cannot be diversified. It is an undiversifiable risk. Now, come to the another important point, discount rate selection. That is which discount rate to be selected. uh, just come to the second bullet point. It is the second point is important that when cash flows available to the equity shareholders are discounted, the required rate of return is an appropriate discount rate. Okay. For equity shareholders, that is for equity shareholders, the cost of equity is the discount rate. And when the claims of all the company stakeholders have to be made, all the company stakeholders means not only the equity shareholders, but also the debt holders. So all the company stakeholders, what it means, equity as well as debt. Then the cost of capital is used, or you can say more specifically, the weighted average cost of capital is used, as you have studied in your cost of capital chapter. So when the required rate of, when the cash flows to be available to the equity shareholders are discounted, cost of equity is used. And in case of when both debt and equity is involved, the discount rate which is used is cost of equity, cost of capital, or the weighted average cost of capital. Now, concept of nominal cash flow and the real cash flow. Nominal cash flow is the amount of future revenues the company expects to receive and the expenses it expects to pay out without any adjustment for inflation. So in nominal cash flow includes inflation. In nominal cash flow, there is no adjustment for inflation in case of nominal cash flow. But in case of real cash flow, the inflation is adjusted. Okay. So now the next dilemma is which discount rate to be used. The simple point is that in case of nominal cash flow, the nominal rate of discount is used. And in case of real cash flow, the real rate of discount is used. But what about valuation of equity shares? In valuation of equity shares, whether the nominal discount rate is used or the real discount rate is used. Here, in the second bullet point, it is mentioned that while valuing equity shares, only nominal cash flows are considered. Therefore, nominal discount rate is used. So in valuation of equity shares, nominal discount rate is used. Why? What is the reason? The reason is that the tax applying to the corporate earnings, the tax applied to corporate earnings is generally stated in nominal terms. Therefore, using nominal cash flow in equity valuation is the right approach because it reflects taxes accurately. Because of the tax, you can say point tax issue, the in valuation of equity shares, the nominal cash flow is used. Since nominal cash flow is used, then nominal discount rate is considered. So which discount rate is used while valuing equity shares? The nominal discount rate. Okay, Masha, you have sent your question on the point chart, then it will be duly considered to you. But don't worry, during the course of my lecture, I will also clear to you this point and figure chart. So don't worry. Now come to valuation of equity shares. In order to undertake equity valuation, an analyst can use different approaches, some of which are discussed as follows. So there are three basic approaches to valuation of equity shares, which is dividend based model. First is dividend based model. Second is earning based model. And the third is cash flow based model. We will discuss all this one by one. First of all, let us take dividend based model. In dividend-based model, there are three assumptions. First, dividends are paid annually over an infinite period. This is also in Gordon's model. So in dividend-based models, basically the Gordon's model is followed. That first of all, dividends are paid annually over an infinite period till perpetuity. Okay. Second point is that the payment of first dividend shall occur at the end of the first year. And third, sale of equity shares shall also occur at the end of the year. So these assumptions are made so that the valuation can be more, you can say, simpler, relatively simpler. For that, the Gordon has enumerated the three assumptions. These assumptions will be more clear to you when we will further proceed during this lecture and do practical questions. So don't worry, these points will be more clear to you as we proceed further. Okay. Now come to the dividend-based model continuation. The value of any asset depends on the discounted value of cash streams expected from the same asset. Accordingly, the value of equity shares can be determined on the basis of stream of dividend expected at required rate of return or opportunity cost of capital. So what is dividend-based model is what in simplified language, basically a dividend-based modules. First of all, dividend is estimated. First of all, the dividend is so dividend based models. The dividend is basically Dividend is basically estimated. Dividend is estimated. Future dividend is estimated. How it is estimated? It is estimated on the basis of past figures कि पिछले साल में इतने परसेंट, पिछले 5 years का 10 years का डिविडेंड देख लिया कि हाँ, इतने डिविडेंड डिक्लेयर किए गए हैं. ऑन दैट बेसिस द फ्यूचर डिविडेंड इज एस्टिमेटेड कि अगले 5 साल तक, लेटेस्ट से अगर कंपनी ने 10 रुपए डिविडेंड डिक्लेयर किए हैं 10 से 15 रुपए के बीच में, तो नेक्स्ट 5 years में 20 रुपए डिविडेंड डिक्लेयर होगा. द फ्यूचर डिविडेंड इज एस्टिमेटेड. देन द डिस्काउंट रेट इज फाउंड आउट. Second is discount rate. Then if the it is seem feasible that the company is growing, then the growth rate is also calculated. Growth rate, if the you can say valuer thinks that the company will grow, then it will also estimate the growth rate. Then the future dividend is discounted on the basis of this discount rate. So this what happens in the dividend based models. Now, come to the different situations that dividend-based models, there are two approaches actually. Dividend-based model. I think from this it will be more clear to you. Hold shares for 1 year and hold shares for more than 1 year. If it is hold shares for more than 1 year, then there are different situations. First is that the company follows a zero growth dividend policy. The company follows a zero growth dividend policy. Second, company follows a constant growth dividend policy. For example, companies giving dividend, or you can say dividend at a growth of 10%. The company, whatever dividend company is giving, it is giving at an increasing rate of 10%. Every year increasing dividend at 10%. So this company is following a constant growth rate. हर साल वो 10% जो कंपनी डिविडेंड रेट इंक्रीज कर रही है, दैट इज अ कांस्टेंट ग्रोथ रेट. जीरो ग्रोथ रेट मींस कंपनी डिविडेंड में कोई ग्रोथ है ही नहीं. जीरो ग्रोथ मींस अगर 10 रुपए कंपनी डिविडेंड डिक्लेयर करी तो हर साल 10-10 रुपए पे कर रही है. दैट इज द जीरो ग्रोथ रेट. कांस्टेंट ग्रोथ रेट, कांस्टेंट फिगर 10% एवरी ईयर. एंड वेरिएबल ग्रोथ रेट. वेरिएबल ग्रोथ रेट means company declares dividend for say 10% for first 5 years. Then it declares dividend at 5% till infinity, till continuity. In this way, it can happen, or this is called actually the two stage model, and further it can vary three-stage model also. For first 3 or 5 years, say the company declares dividend at 15%. Then for the further 5 years, it declares dividend at 10%, and then 5% till infinity. So this is basically a flow chart on the basis of which I try to explain that how this dividend based model goes about. So dividend based model, there are two approaches. If you hold shares for 1 year, you can hold shares for more than 1 year. If you want to hold shares for more than 1 year, then there can be, it depends upon the company to company, whether the company is following a zero growth rate dividend policy or constant growth rate dividend policy or variable growth rate dividend policy. We will all these situations separately with the help of an example. So let us proceed with the PPT. Now, the first approach, that is valuation based holding period of 1 year. Means if an investor holds the share for 1 year only, then the value of equity shares is computed as per the following formula. It is D1 upon 1 plus KE plus P1 upon 1 plus KE. Let us take an example in this. Say, say 1 year dividend is 1 year dividend is rupees 5. Uh, Price, which is P1. P1 means price at the end of year one. Price at the end of year one is equal to 20. Okay. And the required rate of return or the discount rate is 20%. So let us take an example. 1 year dividend is 5 rupees. The investor wants to hold the shares of a company for 1 year. Dividend is 5 rupees. Price at the end of the first year, the share price at the end of the first year is rupees 20. The discount rate is 20%. So how we will calculate? In this case, P0. What is P0? P0 means price at the current market price, means price today. This P0 actually denotes the price, the current price, the current price or the price at today itself. That is denoted by P0. So P0 is equal to D1. What is D1? D1 is the dividend at the end of the first year. So this is D1 is equal to dividend at the end of the first year. And KE is actually cost of equity in this case. I think I will make you more clear to this. Okay. Now what is this dividend? D1. D1 is dividend at the end of first year. D1 is dividend at the end of first year. What is P1? P1 is price at the end of first year. And what is KE? KE basically the cost of equity or the discount rate at which dividend at the end of first year and the price, market price at the end of first year is discounted to arrive at the present value. Means जो dividend है जो एक साल बाद रिसीव हुआ D1 उसकी वैल्यू और P1 जो मार्केट प्राइस जो एक साल बाद रहा उन दोनों को डिस्काउंट करने के बाद जो प्रेजेंट वैल्यू आई अभी की वो हमें डिपिक्ट करनी है फॉर 1 year ओनली बिकॉज द इन्वेस्टर वांट्स टू होल्ड द सिक्योरिटीज फॉर 1 year. Now calculate this. 1 year dividend is 5. Put the figures into the formula. P0 is equal to 1 year dividend 5 upon 1 plus KE. What is the discount rate? Discount rate is 20%. So 1 plus 0.20 plus P1 market price is given in the question rupees 20. 20 upon 1 plus KE. 1 plus 0.220. Let us solve this. It is 4.17 plus 16.67. So it will come to 20.84. 20.84. Okay, so this way it can be solved. So I hope it is clear to you. Any doubt regarding this? Yes, as I have already said that in cost of equity, the nominal discount rate is used. So yes, it will be considered as the nominal discount rate. As I've just said, for valuation of equity shares in case of cost of equity, it is the nominal discount rate. Shruti, don't worry. I will do. There are some questions coming up for every concept. I am taking a practical example, and there is an assignment also, which you will be able to solve. So you will solve it all along simultaneously. So in this case, the concept will be more clear to you. So first of all, let us concentrate on this dividend day based model. So I think this is the first method I have taken, valuation based holding of 1 year. I will be taking valuation based on multi-holding. After this small break, any question till that, I will be happy to answer that. So, jot down your queries. I will be taking the queries and will proceed further after this brief break of about 10 minutes. So, thank you. Ashok ji, अशोक जी, हाँ ब्रेक ले लीजिए 10 मिनट का. Yes, students, welcome back. Okay. Now, first, we have discussed the valuation based holding period of 1 year. If an investor wants to hold the share for 1 year only. And now come to multi-holding period. Means if a particular, you can say, investor wants to hold the share for more than 1 year, then what will be the situation? There are three different situations, as I have discussed during this my flow chart also, that zero growth dividend policy, constant growth rate, and variable growth rate. What it is and how it affects the decision of the investor. We will see in this further slides. Now, zero growth rate. Zero growth rate means no growth model, as dividend amount remains over the same infinity. Means a company is declaring dividend at rupees 10. So it will continue paying dividend at rupees 10 for you can say a large number of years or till infinity. So this is the zero growth rate, as the name signifies. The formula is simple. P0 is equal to D upon K. Let us take an example. Dividend 20%. Dividend 20%. Face value of a share is equal to rupees 100. And required rate of return, that is the discount rate. Required rate of return, that is the discount rate, is equal to 15%. Now put these figures into the formula. P0 formula is P0 upon D upon K, means but dividend is discounted at the cost of equity capital. Dividend face value is 100, 20% of 100, the rupees 20 upon 0.15. Let us calculate this. $133.33 is the answer. So I think its answer is coming to you 133.33. But this zero growth rate model, it is actually not feasible. It is actually not possible and actually not practical also. Because if you see in real life situation, the company generally declares dividend at different amount differently every year, or you continue declaring dividend for 10% for some years and then it increases its dividends. So the zero growth rate policy is entirely actually impractical. It is not practical. It is not feasible also. So it is practically generally not followed by the company. Zero growth rate. Now comes to constant growth rate. Constant growth rate means the company is following a fixed dividend growth rate policy every year. Means company is paying dividend at a rate of increasing rate of 10% every year. Means company जो dividend rate है वो 10% हर साल से 10% बढ़ा रही है, 10%, 10%, 10%. So this is constant growth rate. Again, this is also not practical because in real life situation, most of the company declares dividend at different rate. So it is not that it is declaring dividend at 10% or 50% every year for continuously. So this is also an impractical proposition. What is the formula in case of constant growth rate? It is D1 upon KE minus G, or D0 into 1 plus G upon KE minus G. Let us take an example. Constant growth rate. Constant growth rate P0 is equal to D1 upon KE minus G, or it can also be written as D0 into 1 plus G upon KE minus G. So what is this D0? D0 is the present dividend. D0 is the present dividend. And what is D1? D1 is the dividend at the end of the first year, as I have just discussed before, that D1 is the dividend at the end of the first year. So it can be either written as D1 or it can be written as D0 into 1 plus G. G is the growth rate. Means when D0 is multiplied by the growth rate, it is actually when D0 is multiplied by growth rate, it comes to D1 or dividend at the end of the first year. This is basically the Gordon's formula, and it is basically a shortcut method. And a very important assumption of Gordon is that the the company will pay dividend at this rate continuously for an infinite period of time or till perpetuity or continuously. So this is an important assumption of the Gordon's model, that the company will pay dividend at a certain rate for a constant rate for a continuous period of time till infinity, till perpetuity. So this is basically a shortcut formula. Longer formula is that it is calculated as D0 into 1 plus G upon, it will be 1 plus KE 1 plus D1 into 1 plus G upon 1 plus KE will be square plus D2 into 1 plus G upon 1 plus KE 3. So this is basically, it is done. Means dividend at the end of the first year, it can also be written as D1. It can also be written as D2. It can also be written as D3. So whatever dividend is received at the end of the first year is discounted to arrive at the present value. Same is the case with dividend which is received at the end of the second year, discounted to arrive at the present value. Dividend received at the end of the third year will be discounted to arrive at the present value. And so on. So this process is a long process, and it has to be done continuously. For this, a shortcut formula is arrived, and this is what the shortcut formula is. That is, P0 is equal to T1. P0 is equal to D1 upon KE minus G, or D0 into 1 plus G upon KE minus G. This is one and the same thing. I will give an example. Let us say dividend is 15%. Face value of shares is rupees, say 100. G, which is growth rate, is equal to 5%. So what the company investor is assuming? Investor is assuming that the company will pay dividend at the rate of increasing rate of 5% every year. Means 5% increase हर साल जो है company dividend देगी. हर साल 5% increase करेगी dividend पे. That is the basic assumption. The growth rate is 5% and KE, that is cost of equity, is equal to 20%. Now, put the figures into the formula. P0 is equal to D1 upon KE minus G, or it can also be written as D0 into 1 plus G upon KE minus G. So dividend is face value 100. Dividend is always calculated at the face value. So 15% of 100, it is 15. And it will be 1 plus growth rate, which is 5%. KE discount rate 20%, 0.20 minus growth rate 0.05 is equal to, let us calculate this. It's 15.75 divided by 0.15. So let us calculate it. It is coming at 105. It is coming at 105. Okay, fine. Any question regarding this? So now I will be taking the variable growth in dividend. Just read this slide first, that just like constant dividend assumption, the constant growth assumptions also appears to be unrealistic. Constant growth assumption is unrealistic. Zero growth rate also unrealistic. Practically it doesn't happen this way. The company declare dividend at different rates every year, as you have seen in the case of various companies. Accordingly, valuation of equity shares can be done on the basis of variable growth in dividends. Practically, it happens. It should, however, be noted that though we can assume multiple growth rates, but when one growth rate shall be assumed to be for infinity, only then we can find value of equity share. Student, this last sentence of this particular slide is very important. Just read it again. That it should, however, be noted that though we can assume multiple growth rates, but one growth rate shall be assumed to be for infinity. We have to come at a situation when we have to assume that at this growth rate, it will continue for till infinity, till perpetuity, or for a long time to come. Say, for example, we assume that the company will declare dividend at 10%, or we can say this way. For 10%. First 5 years. 5 years. Then it will declare dividend at the rate of 8% till infinity. Till infinity. So at a particular level, it has to be assumed because it is the basic assumption of the Gordon's formula that at a certain point, we have to assume that the company will pay dividend at a certain rate continuously till infinity, till perpetuity for a time, certain period of time, in order to have a, you can say, arrive at a certain amount of value. This portion will be more clear to you when we will do more practical question in this cases, variable growth rate. Then come to two-stage dividend discount model. First of all, the two-stage dividend discount model, first go through the slide and we will take example also. While simple two-stage model assumes extraordinary growth or supernormal profit shall continue for finite number of years, the normal growth rate shall prevail for infinite period. So in two-stage dividend discount model, it is assumed that for certain years, say for example 5 years, the company will grow at exponential rate, at a growth rate of say 15%, 20%. After that, the growth will subside. It comes at a maturity stage and the company will grow at the rate of 10%. So in this model, the formula is this. This is the formula in front of you. This formula, by looking at this, seems to be a quite ominous one. Seems to be a ominous one, seems to be, you can say, a complicated one. But I will take an example and try to explain it, that without aiming, even remembering this formula, or by going through this example, you will able to very well correlate with this formula also, because at first hand, you will not be able to understand what this formula tries to signify. So first of all, let us take an example and then we will come to the formula also. For example, let us take dividend at rupees 2. Let us take dividend at rupees 2. Growth rate for G for first 3 years is equal to 10%. For first 3 years, let us take it is growing at 10%. Then it will grow at 5% annually, 5% annually till infinity, or till perpetuity. KE, the discount rate is equal to 15%. Okay. So let us solve this problem. Just give me a minute. In the meantime, we can start solving this question. Okay. Let us solve it for first 3 years at 10% growth rate. So let us first calculate the present value at the 10% growth rate. Okay. Now, at the end of first year, at the end of second year, at the end of third year, what will be the dividend? Present dividend is rupees 2. So it will be multiplied by the growth rate. What is growth rate? Growth rate is 10%. 2 into 1.1 is coming to 2.2. So dividend at the end of the first year is 2.2. Then dividend at the end of second year will be dividend at the end of first year multiplied by the growth rate. Okay, 2.2 into 1.1 is 2.42. Then dividend at the end of third year will be dividend at the end of, sorry, dividend at the end of third year will be dividend at the end of second year multiplied by the growth rate. Okay. It is 2.66. Now we will multiply this dividend with the present value factor in order to arrive at the present value. So 2.22, and let us write down the present value factor at 15%. It will be for first year it is 0.870, second year 0.756, and 0.658. So first year we multiplied 2.2 into 0.870. It is 1.914. Let us calculate the second year. Dividend 2.42 multiplied by 0.756 is coming to 1.83. For third year, 2.66 multiplied by 0.658 is 1.75. Let us add all this. It is 5.494. So this is the present value. This is the P0 present value at 10% growth rate. 10% growth rate or 10% G. Now we will calculate the present value at 5% growth rate, because from the fourth year onwards, the growth rate changes. It is given in the question that now it will grow at 5% annual. It means from fourth year onwards, now the growth rate is not 10%. The growth rate is 5%. So now we will calculate present value at 5% growth rate. So it will be denoted by P3 is equal to P3 is equal to D3 1 plus growth rate upon you can take this at growth rate 2 because growth rate is now changing, then KE minus growth rate 2. Or alternatively, you can also write it as D4 divided by KE minus growth rate 2 when the growth rate is changing. Here, student, one question may arise that some of you may find it confusing that why P3 is taken and not P4 is taken at this point. This is because it is the price at the beginning of the fourth year. So price at the beginning of the fourth year or price at the end of the third year. Because for the first 3 years, we have taken what is the present value. So it will be that we will take the present value at the beginning of the fourth year. Because when we calculate the present value, we denote it as P0, means the current dividend, and we take dividend at D1, that is dividend at the end of the first year. So dividend at the end of the first year is discounted to arrive at the present value now. In the same way, in the same logic, the dividend at the end of this fourth year is discounted to arrive at the dividend at the beginning of the fourth year. Dividend at the end of the fourth year discounted to arrive at the beginning of the fourth year. Or dividend or present value at the beginning of the fourth year or present value at the end of the third year is one and the same thing. That is why it is denoted by P3. So P3 is D3 into growth rate, or you can also alternatively write it as D4 also upon KE minus G2. Now let us put the figures into the formula. D3 dividend at the end of the third year, we have already calculated 2.66 multiplied by the growth rate. Now the growth rate is 5%, not 10%. KE minus G discount rate is 15%, 0.15 minus 0.05. Let us calculate this. $3.059 divided by 0.10. So it is basically coming to let us 0.6 into 1.05. So I beg your pardon. This is actually this figure is 2.793 2.793 upon 0.1. So 2.793 upon 0.1, it will come to 27.93. 27.93. So P3 is coming to 27.93. But we have to calculate the present value. This P3 is the present value at the start of the fourth year. We have to arrive at the start of the present. We have to calculate the present value, means at the start of the first year. So we will calculate the present value, that is P0 at 5% growth rate is equal to 27.93 multiplied by the present value factor, which is third year is 0.658. Is coming to 18.38. 0.38. So we have two figures now, present value at 10% growth rate and the present value at the 5% growth rate. So now we will calculate the present value at both this growth rate. We will total. That is the present value at both 10% and 5% growth rate. So it will be 5.494 plus 27.93. Sorry, 5.494 plus this figure, 18.38. The answer is coming 23.87. 23.87. I hope everybody is having the same answer to this practical question. Actually, don't get confused. That is the growth rate is, see, the growth rate is 10% for first 3 years. And the growth rate will be 5% from fourth year onwards till infinity. Okay. We are considering here we are considering the growth rate from fourth year onwards. That is why 5% growth rate is taken, not the growth rate of the third year. Because for first 3 years, the growth rate is 5%. And from fourth year onwards, the growth rate is 10%. So simply, we will multiply this dividend at the end of the third year with the growth rate of 5%, which is from the fourth year onwards. Okay, any questions? Manjutha, this principal value is not ignored. You can say that if the principal value is taken, that market price is taken when the shares are held for 1 year. We know what is the share price at the end of the first year, because the investor wants to hold it for 1 year only, want to hold the shares for 1 year only, right? But in this situation, it is not given in the question, and it is not clear also, and it is not clear in the sense and not clear in the mind of the investor also at what period he wants to hold the share when he wants to sell it. It is not actually pre-planned. So in Gordon's model, there is a basic assumption that at certain period of time, we have to assume that the dividend will grow at a continuous rate till infinity. We do not know at which point, at what market price it will be selling it. So you can say whatever future dividend is actually the return which the investor is expected to receive also. There are certain other valuation models also which we'll be discussing, that is earning based model. In this way, in that situation, the dividend is not considered, and free cash flow method also, which we will be discussing. In that case, it will be more uh, clear to you. Okay, so shall we proceed further? So this is the two-stage dividend model. Here you see that the formula which is given to you is this first portion. Let us take this first portion. Let us take this first portion. Okay. So this is the portion which I have. What this is say, it is for up to 3 years. This is the portion is here. This portion. This portion. For all the 3 years. See, for first year, we have calculated the dividend and then we discounted the dividend to arrive at the present value. Second year also, we calculated the dividend and arrive at the present value for third year also. And then we calculated the total present value at 10% growth rate for first 3 years. So this is the basic formula for the this first portion. Now the second portion, what this is? This is PN. PN is called the terminal value. This is terminal value. And this calculation of terminal value is given as follows. What is the terminal value? Terminal value is the value at the start of a growth period from which the dividend will grow continuously. I repeat, the terminal value is the start of a period from which the growth rate will increase at a continuous rate till infinity. So what will be what is the stage? In this example, the stage is from the stage is from the beginning of fourth year or at the end of the third year. In this example, we have considered that from fourth year onwards, the dividend will grow at 5% annually. Okay. So this portion we have calculated P3 is equal to D3 into 1 plus G2, K minus G2. This is the formula basically. This portion we have covered. So D0 into 1 plus G1 is actually nothing, but it is actually the amount of D4. Okay, and D4, this whole portion actually D4, and this is the K minus G2. K minus G2 we have already arrived at 0.15 minus 0.05, this portion. This portion. And then this one. And this one. This one. It is discounted. That is discounted to arrive at P0. Because here we have actually calculated the P3, this P3. That is beginning of the fourth year. But we have to arrive at P0. Therefore, we arrived at P0 by multiplying this figure of at the beginning of the fourth year with this discount rate 0.658, this 18.38. It is at the P0 arrival, P0 value. So this way it is has been calculated. So you do not have to remember, you have not to this cram this formula. It can be easily calculated by this method also. This is a simplified method. So you can calculate by this method also. In the assignment question, I will take both the methods, but you can correlate this and a task is given to you. This portion I have solved it to you. You please try to solve by applying this formula also. So this is the task which I have given to you. While doing the practical question, the assignment question, I will solve this by this method which I have saw just now, and also by this method, by the formula. But what I have explained to you, please try to solve it by this formula, both these methods at your home, this problem, this example. Okay. Now come to three-stage discount model. So what is this three-stage discount model? In the initial phase, it is generally assumed that a firm grows at an extraordinary high rate. For example, 15%, 20%. After that, its advantage gets depleted. It comes at a saturation stage, maturity stage, and there will be a gradual decline in its growth rate after some years. This phase is called the transition phase. This phase is called the transition phase. That is the gradual decline. It is called the gradual decline phase. Gradual decline. For first few years, for 3 years, 4 years, 5 years, the company will increase at extraordinary growth rate. Then there will be a gradual decline. This is called the transition phase. Then follows a stable growth rate phase, in which the G will be fixed and continue till infinity. Continue till infinity. Because what is the basic assumption of the Gordon's model? That at some stage, for the purpose of valuing the equity shares, we have to assume that the dividend will grow at a certain rate till infinity, till perpetuity, till continuously. Okay. So I will take a question in this, practical question, so that it will be more clear to you. There is another version of this three-stage model is calculated in the same way as two-stage model. Because if, for example, if a particular company is growing at 20%, say 20% for first 5 years, 20% for first 5 years, then it is decreasing at, you can say, 3% for next 3 years. It is declining at 3% for next 3 years. So it is the transition period. It is the transition phase. And then you can say it is a stable at 10%, and this 10% is followed till infinity. So this way, the three-stage discount model, just like the two-stage discount model, it is calculated at different rates. But there is an alternative to this three-stage discount stage, which is called the H model, and it is more, you can say, a simplified version of this three-stage model. In this model, in the first stage, the dividend grows at high growth rate for a constant period. Okay. Then in second stage, it declines for some constant period and finally grows at a sustainable growth rate. Formula for this three-stage dividend discount model under H model is, it is given in front of you, D0 into 1 plus Gn, R minus Gn. Okay. Now this Gn, what is this? Gn is the normal growth rate period. This GC is current growth rate, the initial growth rate, and H1 is the half of the duration of the transition growth period. This is important. What this is? Half of the duration of the transition growth period. Say for example, the transition growth period is 3 years. What is the transition growth period? Transition growth period means after the extraordinary growth rate, the company's growth rate declines at a certain rate. For example, it is declining at 3% every year for next 3 years. This is the transition phase. So it will be half of the duration of the transition phase. So if the transition phase is 4, half of the duration will be 2. If the transition phase is 3 years, then half of the duration it will be 1.5. Okay. So H1 will be calculated by this, and rest of the portion will be more clear to you when we do a practical question in this regard. GC is current growth rate and GN is normal growth rate. For example, normal growth rate is say fixed at 10%, and the current growth rate, that the initial short-term growth rate, say it is up for 15%. Okay. And R here is basically it is the KE itself, that is cost of equity. It is the cost of equity, or it is, you can say, the discount rate. R is basically the discount rate in this case. Okay. So shall we proceed with the question? Okay, now. Okay, let us take an example first. Three stage dividend discount model. Let us say dividend is equal to 2.5. K is 10%. Cost of equity or discount rate is 10%. Let us say dividend grow at 18% for first 3 years. Dividend grows at 18% for first 3 years. Then it then it decline then it decline at 3% for next 3 years. For next 3 years. Okay. Finally finally settled at 8% growth rate till perpetuity or till infinity. So again, read this question. It is a three-stage dividend discount model question. Dividend 2.5, KE, discount rate, cost of equity 10%. Dividend grow at 18% for first 3 years, exponential growth rate. Okay. Then it declines at 3% for next 3 years, transition phase. Finally settled at 8% growth rate till perpetuity, stable phase. Means it will grow at 8% till infinity. Now, how to solve this problem? We will solve this problem with the help of the this H model, because it is simpler and it is easy to. अशोक जी, अब आ रही है आवाज? कितनी देर से नहीं आ रही थी? थोड़ी देर मतलब 5 मिनट हुआ होगा। अच्छा ठीक है, मैं देख, चलो ठीक है, मैं एक बार रिपीट करता हूँ, ठीक है, थैंक यू। हाँ ठीक है, अब आ रही है ना बस? ठीक है। ओके स्टूडेंट, वेलकम बैक। देयर इज अ स्लाइट ऑडियो sometime, so let us come back. I will repeat it, which I have just discussed. So we put the figures into the formula. This is the formula P0 into first of D0 into 1 plus Gn. So D0 is 2.5, 2.5 multiplied by 1 plus 0.08. 0.08 is the Gn, that is normal growth rate period, which is 8%. Divided by R, it is R, which is the uh, discount rate, and 0.08, 8% is the growth rate, normal growth rate period. Multiplied by, according to this formula, GC minus GN. Initial transition growth rate period is 1.5. How this 1.5 have come? What is the duration of the transition phase? See, duration of the transition phase is 3 years, because it is here, it is given. Decline at 3% for next 3 years. So it means it is a transition phase. Transition phase is for 3 years. So half of this transition phase is 1.5. So that is why 2.5 into 1.5. 2.5 is the dividend. Now next course will be to GC minus GN. GC is the short-term growth rate, 18%, 0.18, and GN is the normal growth rate, 0.08, 0.08, divided by GC minus GN. That is R minus GN, sorry, R minus GN, 0.10 minus 0.08. So let us calculate this. 2.7 upon 0.02 plus 2.5 into 1.5 into 0.02. Yes, actually plus 3.75 into 0.10 divided by 0.02. Now calculate it further. 2.7 divided by 0.02 is coming to 135 plus 18.75. 153.75. So this is coming to 153.75. So whether this answer is coming to you, 153.75. So how we have proceed in this three-stage discount model? This is the formula of this three-stage discount model. This is the formula. We have simply put the figures into the formula. And this is the logic behind this formula also, because in H model it is generally followed that for generally assumed that first few years the growth rate is exponential. It is very high. Then for certain years, the growth rate is somewhat say, you can say normalized to a certain point. So this is the transition phase. In this cases, the initial growth rate was 18% for first 3 years. Then it declined for 3% for next 3 years. After 3 years, it was stabilized and normalized at 8% till perpetuity. So this is the formula. We just put the figures into the formula. and we arrived at this 153.75. Any question on this three-stage discount model? Student, there is one thing that this H model is a variation of the, you can say, the two-stage discount model which we have earlier studied. So it can be calculated by both this way. In this case, the 3% discount rate is not followed. Only the transition, if you have observed, only the transition phase is actually given. It can be calculated by in the same way we have calculated in the two-stage discount model. That is, first of all, it will be did at 18%, then 3% for next three, then for we decline it at 3% for next 3 years, it can be calculated. Then finally, at 8%, it will be calculated in the same way which we have calculated in the case of the two-stage discount model. Because if you see that the for the first 3 years, it is 18%. After 3 years, for fourth year, it will be 15%. Then fifth year, it will be 12%. Okay. And for the third year, it will be 9%. Okay. So it can be calculated by this way also. That is, it can be for fourth year, it will be calculated 15%. For fifth year, it will be calculated at 12%. For sixth year, it will be calculated at 9%. And from seventh year onwards, it will be calculated at 8%. Means the formula which we have used till mm, dividend will grow at certain percentage till maturity. That is D1 upon K minus G formula. Or alternatively, it can be calculated by this way also, this H model. This is a simplified version of this three-stage discount model. So it can be calculated by both these ways. But for the sake of, you can say, simplicity, for the sake of less complexity, this method can be followed. Okay, any other question into this? Okay, any other question? Okay. Now we will come to the earning based model. In earning based model, let us see the slide first. That as per this model, an investor might be willing to forego cash dividend in lieu of higher earnings on retained earnings, ultimately leading to higher growth in dividend. In earning based model is basically suited to those companies which are actually growth oriented companies, which do not declare dividend every year and which are not actually willing to declare dividend every year because they have profitable investment opportunities. In case of such companies, which are growth oriented companies, the earning based model is more suited to it. Okay. Because in such cases, the investor is willing to forego dividend for higher market price or capital appreciation, capital gain in future. In this case, Gordon model is also used, earning based model. There are two assumptions that return on retained earnings remains the same and retention ratio remains the same. In these cases, the emphasis on retained earnings and retention is more, as logically you must have understood that in this method, the emphasis is on retention of the earnings and investing it on profitable business growth opportunity, not to declare dividend. The formula in this case is EPS 1 into 1 minus B upon KE minus BR. That is, in this case, B is equal to retention ratio. And BR, then KE minus BR. B is basically retention ratio and R is the return on retained earning. So this BR is also called the growth rate. Because whatever retention is there, it is invested into profitable business opportunity, and return what is generated from this profitable business opportunity is the growth. So growth rate is basically B into R, that is a retention ratio multiplied by return on retained earnings. Just give me a second. So let us take an example in this case. Let us say EPS is 10, cost of equity is EPS is 10, cost of equity is 20%. B is equal to 40%, and R, this required rate on equity, is 25%. So you have to calculate the P0 on the basis of earning based model. So it will be EPS 10 into 1 minus B. B is 40%, 0.4 divided by KE minus BR. E again BR, that is 0.4, 0.4 multiplied by 0.25. Let us calculate this. 10 into 0.66 divided by 0.4 into 0.25 minus this 0.1 only. So 6 upon 0.1 is equal to, so answer is coming to 60. The answer is coming to 60. Okay. So this way the earning based model P0 is calculated in case of earning based model. Now come to Walter's approach. Walter's approach is basically, I will not go detail into it because Walter's model you have, I think, solved many problems during your intermediate course. So just for the sake of clarity, just for the sake of briefing it, as you know, in Walter's approach, it is of the view that the market price of a share is the sum of present value of infinite stream of dividend and present value of infinite stream of return from retained earnings. So I will repeat again that it is based on the view that market price of a share is the sum of present value of infinite stream of dividend and the present value of infinite stream of return from retained earnings. The basic purpose is that what is the, you can say, basic assumption of the Gordon models. The basic assumption of the Gordon models is that if you observe K is greater than G, that is cost of equity capital is greater than the growth rate. This is the basic, you can say, is the assumption of the Gordon's growth rate model. And this is basically followed in case of, you can say, Walter's model also. Walters also stick to this assumption, and therefore, if K is greater than R, if K is greater than R, that is the cost of equity or the required rate of return is the cost of equity is greater than the required rate of return on retained earnings. This K is greater than R. It means that there is less growth opportunities. There is less growth opportunities, and the company will declare more dividends. Company will declare more dividends, and Vice versa. If K is less than R, if K is less than R, it means whatever the company is retaining is generating more returns. So the company will declare less dividend. So it is a there will be more growth opportunities or will declare less dividend, less dividend or no dividend. So market value will be higher. In this case, the market value will be highest if there is 100% retention. If there is 100%, if there is 100% retention, the value will be the value will be highest. And in this case, if there is 100% dividend payout, value will be highest. Value will be highest. Okay. So this is the basic concept of this Walters model that if KE is greater than R, then there will be less growth opportunities. Company will declare more dividends. And so if there is 100% dividend payout, the value will be highest. On the other hand, if KE is greater than, is less than R, that is the cost of equity is less than the required return on retained earnings, then the growth opportunities will be more, the company will declare less dividends. So if there is 100% retention, in this case, the value will be highest. Now, next is price earning or the multiplier approach. Just read the slide first that this is one of the most common valuation approaches which is followed. This is one of the most common valuation approaches followed. Since price earning ratio is based on the ratio of share price and EPS with the given price earning ratio and EPS, the share price or value can be determined as follows. So it can be determined by this way. Value is equal to EPS into price earning ratio. Or we will just get to this. How EPS is found out? How market, you can say, first of all, let us take P. How P ratio is found out? P ratio is equal to market price per share upon earning per share, right? So how market price will be calculated? Price earning ratio multiplied by earning per share. So this is basically the what it trying to say, the EPS into price earning ratio. So value is equal to price earning ratio into EPS. But the difficulty which arises is that it is how to calculate the price earning ratio. In this situation, the price earning ratio is calculated with the help of the uh, P price earning of previous years, that is of 5 years, 10 years, on the basis of which the price earning ratio is projected. Similar way, the EPS is also projected on the basis of previous years, the future EPS is projected. The two figures are multiplied and then we arrive at the value, market price per share, at the value at which the particular investor may purchase the shares. But this price earning ratio is not an indicator. It does not indicate that whether a company is good or bad. Price earning ratio only indicate that where the prices of a particular security is cheaper or not. So if the price earning ratio is high, if the price earning ratio is high, it means the share prices are costly. If the price earning ratio is low, then it signifies that the share prices are actually cheaper in comparison. Now come to the next. What is the, okay, I will take the query first. And what is the difference between return on retained earnings and this Return on retained earnings and this retention ratio. See, Prashant, see, retention ratio means how much the company is retaining. Here you will see B. What is this B? B is actually it is the retention ratio. It is the retention. It means the company is retaining 40% of the profit. So how much dividend it is declaring? It is declaring dividend, or it is declaring dividend at this 60%. So it is retaining 40%. And this R is basically return on retained earnings. That is whatever retention is taking place. How much retention is taking place? In this case, the 40% retention is taking place. So out of the 40% amount, say company has profit of 100 crores. So it is retaining 40 crores, 40%. Company has let us say, for example, company has an earning of 100 crores. Out of that, it is retaining 40 crores and it is distributing 60 crores. The 40 crores it is retaining is its retention ratio. Out of 40 crores, out of 100 crores, it is retaining 40 crores. So retention ratio is 40%. These 40 crores it is retaining, it is investing in profitable growth opportunities, some new project or somewhere. Whatever return it is generating from that project, it is the return on retained earnings. So this is the basic difference between the return on retained earnings and the retention ratio. I hope now it is clear to you. Yes, the EPS which is actually taken, it is the expected earnings, because the EPS here, it is estimated. It is the estimated value. So as we estimate dividend in case of dividend based model, so similarly in case of earning based model, we estimate EPS is also estimated, and this estimated EPS is discounted to arrive at the present value. Now, shortly, I will take a glimpse of what the free cash flow method is. I will delve in detail in my next class, the free cash flow method, just to give a glimpse of what free cash flow method is. Actually, as I have said, that there are three different methods for valuation of equity shares. It is dividend-based model, earning-based model, and free cash flow-based model. We have already discussed dividend-based model and earning-based model. This cash flow based model is actually the most popular and most frequently used by the companies. The reason is that they basically consider the cash flow, which is paramount, which is more considered to be more important in case of dividend and case of earning. But some dividend paying companies, which are high dividend growth rate companies, which pay dividend on a continuous basis, dividend growth rate is followed. But free cash flow method is followed in case of companies which are, you can say, some risky propositions also, and it is more or less frequently followed by most of the companies. There are two concepts to it: free cash flow to firm model and free cash flow to equity model. What is the difference between these two? Free cash flow to firm model is basically, it is called the free cash flow to firm. Okay. It is also called the unlevered cash flow. It is called the unlevered cash flow. And free cash flow to equity, it is called the levered cash flow. So what is the basic difference? In this case, the impact of interest and debt is not considered. And in this case, the impact of debt is impact of interest and debt is considered. Unlevered cash flow means it is the cash flow which is applicable to all the stakeholders, debt holders, equity holders. Free cash flow to equity, the emphasis is only on the equity shareholders. Okay. So how this free cash flow to equity is calculated? Free cash flow to firm is calculated as net profit after tax plus interest, 1 minus T, 1 minus tax, plus depreciation, minus capex. Capex is capital expenditure, minus any net change in working capital. Here you can say that the interest is actually added back, because in this case, the impact of interest is not taken. From profit and loss account, the interest has been deducted. So it has been added back because the impact of interest is not taken. So it is added back further. Depreciation, it is, is added back to calculate the cash flow. Any capital expenditure is deducted. Any net change in working capital is deducted. Whatever payment is made is deducted in order to arrive at the net cash inflow, free cash flow. This is the free cash flow to firm. Then how free cash flow to equity is calculated? Or there is another variation, that is free cash flow to equity is calculated from the also from net operating from cash, net operating cash flow. If it is calculated from net operating cash flow, then interest is added back minus capex minus change in working capital. Minus change in working capital. Because now depreciation is not added back, because depreciation is already considered in net operating cash flow. Okay. And how this free cash flow to equity is calculated? It is the levered cash flow. In this case, the impact of interest and debt is not considered, mind you. So it will be NOPAT. New NOPAT is net operating profit after tax minus plus depreciation minus any capital expenditure by way of cash outflow, any net working capital changes by way of cash outflow, plus new debt raised minus debt repaid. Because in this case, the impact of debt is considered because it is the levered cash flow. So that is why the interest is not added back, because interest is already deducted in the profit and loss account. Its impact is already taken. Therefore, in free cash flow to equity, the interest is not added back. Depreciation is added back in order to calculate the operating cash flow. Any capital expenditure deducted, any working capital paid, any changes deducted, any new debt issued, any debt which is come in the form. So this is a cash inflow, therefore it is added, any debt raised, and any debt repaid is deducted because cash is going out. On this way, the net cash inflow, that is free cash flow to equity, is calculated. So this is the basic difference between these two. I will take a small example also, and we'll do a one question on this free cash flow to free cash flow method. Okay. So any question up to this? Any question? Any further questions? So what are we studied today? We have studied what basic concept. We started with very basic concepts of discount rate, required return on equity, internal rate of return. Then we also understood the you can say equity risk premium, market risk premium. We also discussed nominal cash flow and real cash flow. We have seen that in case of real cash flow, real discount rate is used. In case of nominal cash flow, nominal discount rate is used. But in case of valuation of equity shares, nominal it is cash flow is used, therefore nominal discount rate is considered. We have seen that there are three valuation models in case of valuation of equity shares: dividend based model, earning based model, and the free cash flow based model. Dividend based model, we have seen the various intricacies also. That is, when the investor wants to hold the share for 1 year, then how it is calculated. If the investor wants to hold it for multiple period, then also there are three situations. That is, zero growth rate, means it is assumed that the dividend will not grow at all. This is not a practical consideration. Second, that it is assumed that the dividend will grow at a certain rate constantly. It is not also a practical proposition. Third way is that the dividend will grow variable growth rate. The dividend will grow, but there are two stages we have seen: two-stage dividend discount model and three-stage dividend discount model. In case of two-stage dividend discount model, we have seen that the company will declare dividend at a super normal rate, extraordinary rate for certain years, 4 or 5 years, and then it will pay at a normal growth rate. Say initial few years is pay at 15%, and after 5 years it start to pay at 10% till infinity. That is the basic assumption of the Gordon's formula. That Gordon's formula assumption that the company will pay dividend at a certain rate till infinity. The formula is used as D1 upon K minus G. Then we also saw the three-stage discount model. It is calculated in the same way as two-stage dividend discount model. Only variation is there is an alternative to this three-stage discount model, that is the H model. H model, as we have seen, is more simpler to calculate and it's less complicated. And we have taken an example. By this way, we have solved this question, three-stage discount model. And then we came to the earning based model. There are two concepts: free cash flow to firm and free cash flow to equity. Free cash flow to firm is a, you can say, unlevered cash flow. That is the cash flow which is available to all the stakeholders of the company, debt holders as well as equity holders. Whereas cash flow to equity is the cash flow which is available only to the equity shareholder. Therefore, the impact of debt is, since it is a levered cash flow, the impact of interest and debt is taken. In free cash flow to firm, since it is an unlevered cash flow, the impact of interest and debt is not taken. So there are some, you can say, slides remaining on enterprise value, valuation of right shares and valuation preference shares. We will finish that in my next class, and then we proceed with the assignment question. So thank you for this session, and have a good day.
Thank you, Vivek.
Thank you, sir.
Students, you have taken the session very well session, and there are some queries on which I would like to discuss. There was one student was asking, sir, is this the same chapter? I think one student, the cost of capital, something like he has asked one. Sir, is this chapter same as cost of capital of financial management in intermediate level? Student, please here note that basically, Vivek, can you stop sharing your screen?
Sure, sir, sure.
Student, as I told you in my first class, that the topic of security valuation is basically, you can say, it is the opposite of cost of capital. The chapter that you have covered, sorry, the chapter, the chapter that you have covered at your, one second. the chapter that you have covered at intermediate level. Reason is that uh, here, when you have to, in a cost of capital in intermediate level, you need to calculate KE. Okay, where, one second, where you have been given like D1 upon my P plus G. Okay, here this factor is unknown. You have been provided with this factor, this factor. In the current chapter that is on security valuation, you will be provided with this because this is the expected rate of return of a shareholder. Okay, so you will be provided with this. You will be provided with this figure. You will be provided with this figure, and this figure you need to compute. Accordingly, the formula becomes, this is, you can say P0, that how much price we need to pay, D1 upon my KE minus G. So accordingly, the chapter basis is earlier that we have done, that is cost of capital, and we have done at intermediate level. Of course, it is the same, but it is not the same, but it is, you can say it is the basis, forms the basis of the same chapter. Now, another question, I am not question, it is a question, it is rather I want to discuss one point. In a chapter 1, we have studied the sustainable growth rate, if you recall that. Okay. Now, when Vivek sir was teaching the two growth model, so at that time there was two growth model and three-stage growth model. So there was we have noted that once growth rate takes this way, then it becomes stable. In a two-stage model, somewhere it goes like that, then it becomes stable. So three-stage. So here in this, say, this growth rate is basically sustainable growth rate. So we can see that the chapters are quite somewhat linked. Okay, the chapters are somewhat linked. So it is very important to note. So accordingly, my request to you, we can understand that basically all chapters are quite interrelated. Concept of beta has been discussed. That is also covered in the portfolio management. Okay, so with, if you develop a comprehensive approach, then certainly it will help you to uh, understand the concept in a better manner and score good marks. Now, as usual, if you have any query, 1 minute, Shahrudin sir, particular concept, if we have assignment question, it will after the particular concept, if we do have a questions, I will it will be a grateful. Okay, Shruti, I will discuss it with Vivek sir. Then certainly we will work upon that. Thank you for your suggestion. And in the end, as usual, I'm just writing down the number where you can contact us over the telephone, or you can send your query on the mobile BS app. So with this, student, we come to the end of this session, and we thank Vivek sir for this nice session. Uh, so of course, we shall continue this topic in the next class. Thanks a lot for patience listening, and have a nice day. Ashok ji, thank you. Session is over. Okay.